I understand the guts of crypto only marginally better than most people do, having studied them. In fairness, Sprott has made several $1 million of investments in blockchain and distributed technology around distributed ledger technology in precious metals, which is to say gold and silver. And the consequence of that is that I've delved a little more deeply into crypto, being several $1 million exposed, than other people might have. I have a few comments about crypto. The first is I understand the value proposition, which is or was anonymity. That proposition is fading, frankly. Frictionless transaction, which is a fantastic set of circumstances. The fact that the costs involved in documenting and transacting can go damn near to zero, which is very, very useful. The third part of the value proposition that I see that's important to me is the fact that you don't have to trust your counterparty, you don't have to trust your government, you don't have to trust a bank. You trust your peers in the network. I love that. Peer-to-peer trust, peer-to-peer verification, I love. But the most important utility, I think, is the network, which is to say, a cryptocurrency that has one user has no value whatsoever. A cryptocurrency that has 1 billion users, by contrast, has incredible value. Sort of like a telephone. You know, what would you do with the first phone? There's nobody to call. 2 phones? Yeah, okay. 1 billion phones? There's utility. So I get the overall value proposition. What's a little difficult for me to understand is when people talk about the scarcity in crypto. The scarcity disappears if there are multiple crypto products, which is to say there may be a scarcity or a contrived scarcity in Bitcoin, but it seems in particular the younger adherents are looking for the latest hot coin, and the promoters of that coin, if they're unconstrained, can burn as many coins as they can foist on the market, sort of like penny stocks. They can issue them ad infinitum, ad nauseum. The second difficulty I have with crypto is that the price volatility, which so delights speculators, of course, the volatility of the upside delights them the most, actually diminishes the crypto's utility as a medium of exchange. Because unless you live your entire life denominated in one crypto and no other currency, if you go to spend a highly volatile financial product like Bitcoin or Ethereum or one of those, if you go to buy a few sacks of groceries, you don't actually know what you paid. And the grocer doesn't know what he or she received. And the very volatility that delights speculators reduces the utility associated with the coin. So I'm attracted to cryptocurrencies. Listen, Patrick, I'm a consumer of currencies. You know, I spend Canadian dollars, I spend US dollars, I spend euros, I spend Chilean pesos. So to the extent that there are people working on new currencies to serve a currency consumer like me better, I'm all for it. I just think that the very upside volatility that we have seen, the price action has in many people's mind justified the narrative. If you have a hypothetical cryptocurrency and nothing changes with the size of the network, and that currency rises in price from $1 to $5, the fact that it's risen fivefold is attractive to speculators at the same time that arithmetically, you have reduced the price to value proposition by 80%. In other words, if nothing has changed, but the price has gone up fivefold, it's precisely 1/5 as attractive arithmetically. And some speculators don't seem to understand that. Having been in financial markets for 45 years, I know in the Canadian parlance that the backside of what the Canadians call a hockey stick graph is just as steep as the front side, but a lot less fun if you're long. So I would encourage people who are crypto speculators to think through the whole value proposition. Not saying to avoid the space, but just don't confuse price with utility. Yeah, I think that the distributed ledger technology allows us to greatly democratize ownership of gold and silver, first of all. And You're not old enough to remember this, but I remember in the decade of the 70s, a whole bunch of people who didn't trust the government trusted dealers and vaults who weren't trustworthy. So they'd buy $100,000 worth of silver, they'd throw it in a vault, operated by Schlepp, Schmuck, and Schmo somewhere, and they'd go to get their silver, and the silver had gone to silver heaven. In other words, they offset their lack of trust in the system with a trust in a promoter that turned out to be ephemeral. One of the beautiful things about the distributed ledger, if there's 10,000 participants in the verification process, you don't need to trust anybody, which is wonderful. You don't need to trust, JP Morgan Chase, hate to keep picking on them, Deutsche Bank, you don't need to trust the US government, you don't need to trust the Singapore government. The other thing is that we've learned at Sprott that if you store large amounts of gold and silver, that your storage and insurance fees go very, very, very low. If I go to store $100,000 worth of silver at Brinks, my storage and insurance fees as a percentage of my assets under management are relatively high. If you're Sprott and you're storing $4 billion worth, they're very, very, very low. And if the delivery receipt, if you will, is represented on the blockchain by distributed ledger, your percentage share of the storage and insurance fees are infinitesimally low. And then finally, of course, the friction. When a retail investor goes to buy physical silver today, the premium to spot that he or she pays is fairly high. Even in much more efficient products, indirect products, like the Sprott Physical Silver Trust, there are exchange fees, all those types of things. Those fees can be dramatically compressed on the distributed ledger. Finally, the very transferability of units that can be redeemed for physical precious metals means that physical precious metals can again be efficient forms of money. A real money to me is a broadly accepted medium of exchange that's simultaneously a store of value. And it isn't a store of value where the store of value is real but ephemeral, like the size of the network. Rather, the store of value is physical gold and silver. If you can exchange physical gold and silver with a tap of a card or a wink of a phone, but it's a real store of value, it means that you could buy gold and silver to buy a cup of coffee or to buy a house. You could borrow against it, you could loan against it. In other words, gold and silver become legally and functionally what they have been for millennia, which is to say, money. There were decades where I wanted to own and store my own physical precious metals, because in the 70s, I watched so many scam artists steal so much gold and silver from so many good people